I'm Charlotte McLeod with the Investing News Network, and here today with me is Rule of Sprott. Thank you so much for being here online with me today.
Charlotte, it's a pleasure. It's been too long.
Yes, and we're going to jump right into our questions and make up for lost time. I think where we need to start today is with gold. Gold has been trending downward over the last 2 weeks. As we're speaking right now, it's Monday, November 30th. It's under 1800 the last time I checked. Can you give us your take on what's going on with gold right now?
I can, at least I hope. I think the probability is that this is a cyclical decline in a secular bull market. If you look back at the last 50 years of gold markets, there have been two prior real bull markets, one from 1970 to 1981, the next from 2000 to 2011. Both of those secular bull markets were a decade long, uh, and saw manifold increases in the gold price. And both of them were punctuated numerous times by cyclical declines like the one we have seen, the one that we're currently going through. While the gold price in the near term is disconcerting to speculators, if speculators familiarize themselves with the performance of gold longer term in bull markets, I think they become much less concerned. Yeah, I think I'll leave the answer there. This is normal. This is natural. There is nothing that has changed about the case for gold. Those investors or speculators who haven't familiarized themselves with the case for gold may be nervous because their actions have no basis in sort of fact or theory. And I would suspect that people who have a nervousness would do well to re-examine their premise.
All right, now I don't want to dwell too much on what's going on right now with gold. I do have one follow-up question though, which is we are starting to hear some comments suggesting that the momentum around Bitcoin right now is a contributor to gold's price fall. Do you think that's true? Are the people who are buying Bitcoin right now really people who might otherwise have bought gold?
I think only on the margin, Charlotte. There is uh, the motivations for buying gold range all the way from deep fear, gold as an insurance class, all the way to deep greed, that is, momentum speculators. Bitcoin has so much volatility that its utility as a medium of exchange is suspect. So it is moving more on extreme greed. It has certainly a very powerful narrative. But my suspicion is that gold and Bitcoin only compete at the speculative margins.
All right. Now, as you've mentioned before, and as you've mentioned already today, these short-term drivers are less important than the long-term underlying factors that are driving gold right now. In previous conversations, you've mentioned things like quantitative easing, artificially low interest rates, government debt and deficits. For those who might have trouble keeping that big picture in mind, what advice would you have?
Well, re-examine the premise. I'm delighted that you asked the question. The truth is that gold has moved for many reasons over time. And it's important to note that gold is one of the few asset classes that moves both based on fear and greed. But the fear buyer is always the first buyer in gold. And the most predominant fear in terms of moving gold is fear of debasement of the purchasing power of savings denominated in fiat currencies. So let's review them. The first is, of course, quantitative easing. The printing, or by now the keystroking, of additional currency units without a larger economy. This, by its very definition, debases the currency and could easily lead to the depreciation of purchasing power in other savings instruments. The second is more pernicious: debt and deficits. Um, the I don't know the appropriate Canadian number, but I know that US federal government debt exceeds $160 trillion when you add on-balance sheet liabilities to off-balance sheet liabilities. And this is financed, if that's the right phrase, with deficits. In other words, we keep growing the debt as opposed to servicing it. The crowner is, of course, artificially low interest rates, negative real interest rates. The world's benchmark security has been, for my entire adult life, the U.S. 10-year Treasury. It's the security against which other securities are priced. At present, that security yields about 70 basis points, 0.7%, in a currency that the Congressional Budget Office suggests is depreciating by 1.6% a year. Jim Grant calls that is, receiving 70 basis points in a currency declining by 160 basis points a year, quote, return free risk. Gold then is competing, in my books, primarily with return free risk. If someone has examined the premises behind a gold bull market, and somebody wants to know when they get off the train, I think you look at statistics around those three factors. If we were to go in a major economy, either the EU or the United States, for 12 months without quantitative easing, which is to say without counterfeiting, if the deficit in the United States economy in particular was, as a percentage of GDP, less than half of GDP growth for that year. In other words, if we began to be able to grow our way out of our debt, and or if the real interest rate on the US 10-year Treasury reverted to its historic mean, which is to say 200 to 250 basis points real yield. Understand that 250 basis points would have to be on top of the 1.6% depreciation in the currency. So you're talking about a fairly handsome yield compared to today's circumstance. I think when investors come to understand the reasons behind the gold move, they'll have a better sense of when to be on or off the gold market than they will slavishly focusing on short-term price movements.
Okay, well, thank you for that. When we spoke back in March at PDAC, this was toward when coronavirus was first hitting the news in a big way. You were one of the first people to tell me that it could be the trigger for a reset. It wouldn't be a driver. So I want to ask, about 9 months on, how is that reset looking?
Well, I think the reset that happened was entirely predictable. Well, let me rephrase that. Two things. I don't think that the economic impact of the virus has been reflected in either debt markets or equity markets. I think artificially low interest rates has constrained the market's response to the damage done to the global economy by COVID. The second part was entirely predictable. The voters demanded and the politicians complied with the request that they be insured against the market by artificially low interest rates and by quantitative easing. That's a fancy way of saying the government believes, and the voters want to believe too, that you can print yourself out of any crisis. The policy response to COVID is what I think is largely responsible for the move in gold that we saw over the summer. The printing of literally trillions of dollars of specious currency unit has given us liquidity, but Charlotte, it hasn't given us solvency. And people who are curious about gold's role in their own portfolios probably need to ponder the difference between liquidity, that is to say, the availability of cash, and solvency, which is to say, the ability of one to service one's obligations.
All right, so the market has been somewhat insulated then from the effects. Are we going to feel them at any point, or does this just go on and on? I guess we don't know for sure, but what do you think?
Well, I'd love to be wrong. My life is quite pleasant, and to the extent that there was no piper to pay, which is to the extent that none of us have to work anymore, that all we need to do is let uh, Justin or Biden or whoever print, and all we need to do is stay home and eat bonbons and stuff like that. Life is great. I think it defies arithmetic in the longer term, but I certainly hope I'm wrong. Had you asked me the same set of questions in late 2008, I probably would have had the same response. And mercifully for all concerned, myself included, I was wrong. My own suspicion is that arithmetic ultimately works. And the longer that we go without adjusting to the economic reality that we find ourselves in, either the uglier the sharp correction will be, or the longer the gentle correction will be. I don't see any way out of those circumstances, although I wish in the most profound way that I could be wrong.
All right. So looking at the broader gold market, what trends are you seeing among companies right now?
Well, right now, the trends are, at least among the bigger companies, solely virtuous. The truth is, Charlotte, if you remember back to when you came in the business, a rip roaring bull market, uh, the companies really truly wasted that. They made stupid acquisitions, they put stupid projects into production, they wasted literally billions of dollars of shareholder funds. And the consequence of that is that most of the management teams that existed then were allowed to pursue other employment opportunities, which is to say, the shareholders and the institutions fired them. This rise in the gold price has been met with a very different response. There has been a much more guarded fiscal response to prosperity. The mergers and acquisitions that have taken place have been by and large strategic, which are to say good. There has been a real sense that a project needs to generate internal rates of return north of 25% to be undertaken. Uh, and this focus on capital allocation and also the focus on costs has meant that the industry is seeing really record levels of free cash flow. The troubling part of this, of course, is that the exploration and development budgets have been constrained, which means that the company's ability to maintain this production for the next decade or increase that production is challenged. But in the very near term, the industry is dealing with a problem it hasn't had to deal with for many years, which is excess free cash. Do you dividend it? Do you return it to shareholders by buying back stock? Wonderful circumstance. We're also seeing a highly intelligent mergers and acquisition cycle, at least so far. And mergers and acquisitions, if they're intelligently constructed, are a very good thing for the market. You can lower general and administrative expense relative to assets under management by increasing your assets under management without, of course, adding an extra layer of management. Larger companies are invariably more liquid and as a consequence have higher share price, which lowers their cost of capital, which is a good thing. And you spread the opportunity base over a much larger class of investable assets. So I think right now we're in this wonderful sweet spot where the industry returns capital to shareholders either via increased dividends or share buybacks, and where the industry consolidates through merger and acquisition activities. My belief is that the next 18 to 24 months, at least in the mid caps and bigger, which is to say companies sort of above $3 billion in market cap, will be very, very strong. My note of caution in the summer had been that the junior sector, that is the sort of sub 500 million market cap, got way, way, way overheated. But that's begun to correct itself handsomely too.
Right. And of course, my follow-up question was going to be, how do those trends influence where you see opportunities right now in the gold sector?
Well, I'm much more attracted to the gold sector now than I was even 2 months ago. Um, we've talked about this before, Charlotte, you and I. Bear markets or even cyclical declines, if you were buying consumer goods, would be called sales. If you yourself were shopping in Vancouver for a winter coat, the fact that they were in the last 4 months marked down by 30 or 35% would make them substantially more attractive to you. You'd be much more inclined to go buy a coat or buy a better coat than you otherwise would be. Oddly, when we're shopping for financial assets, we seem not to like sales. And the truth is, if we shop for stocks the same way we shop for coats, we'd be better investors. So I'm seeing opportunity really throughout the gold space, starting at the bottom this time. It's delightful to see, to paraphrase the movie, the good, the bad, and the ugly all falling simultaneously. given that there's no requirement to buy the bad and the ugly. I'm delighted to see stocks that I had wanted to own that have fallen by 30 or 35%, which makes them much more attractive than they were in July when everybody wanted to own them. The middle part of the market never really moved. And this is where the merger and acquisition activity has really happened. Free cash flow yields in some of the sort of $5 to $6 billion companies are at record levels, and they look for 5 or 6 years to be fairly sustainable. Either those stocks move up in price or they get taken over. In other words, they either go higher or they go higher. And the biggest companies, the best of the best, the Barricks, the Francos, the Wheatons, are probably fully priced at today's gold price, but they're highly leveraged to higher gold prices, and they're generating absolutely record amounts of free cash flow. It's interesting that many observers, particularly retail observers, suggest that the royalty and streaming sector in particular is overpriced because it's priced at such a multiple to the producers. But the truth is, if you're generating 80 or 85% operating margins relative to 15 or 16% operating margins, you deserve to be higher priced. So that was a long-winded answer to saying that I find the whole sector substantially more attractive than I found it in the summer. And I'm looking forward to deploying a reasonable bit of capital the balance of this year and the first quarter of next year.
All right. Well, speaking about topics we touched on over the summer, another one was the trend of millennials, younger people entering the space here. We speak a lot about what makes a company a good investment, but this time I wanted to ask for those people who may be newer to the space, what can they do to be a good shareholder in the resource space?
Well, the first thing is do the work. And when I say do the work, I really truly mean do the work. I ask people of all ages to limit the number of speculative stocks in their portfolio to the number of hours per month that they spend studying the stocks. And by studying the stocks, I don't just mean focusing on the share price. I mean reading the annual report, reading the quarterly report, reading the proxies. Beyond that, it's really pretty much common sense. By the way, I hear lots of criticism from older, almost dead people like me, of millennials. And this is very, very misplaced criticism. The millennials that I have come into contact with are maybe I hang out with a good crew, but well educated, hardworking, intelligent, narrative obsessed to be true, but that'll be fixed. Importantly, the millennials have better access to information than we ever had. Arguably, you don't even need information anymore because Google has all the information you'll ever need. You need to know how to process information. And the ability that millennials have to generate peer to peer information and peer to peer paradigm without it being fed to them by a university or an investment bank means that ultimately the millennials will be the best investment generation that's ever lived. Now, millennials will have to go through the same learning curve that I had to go through in my 20s. And that isn't always pleasant. But the truth is that that's what you have to do. You have to make some mistakes. You have to do some work along the way.
Okay. Now, returning to a topic we spoke about at the beginning of the year, that's uranium. You gave us some good advice, which was to not enter that sector if you're not patient. But you did also tell us that the market will eventually move, and we did see some movement this year. So I wanted to ask, how are you feeling about that? Does that count as the beginning of the move? Is that not what we're looking for? How are you feeling?
I'm feeling a lot better about the uranium space simply because everybody hates it. It drew a little attention last year, and the stocks bumped up in what I believe to be a premature bump. Uh, to the extent that people have a 2 or 3 year time frame like me, it's okay to begin to invest in the uranium sector today, which is to say, the largest and best companies in the world. Um, I don't think it's too early. My belief is that the uranium price probably doesn't move substantially for at least another year, with the possible exception of in the US, where the uranium industry seems to have succeeded in getting welfare. from the federal government. What that means is that in the developers or the explorers, probably the right way to enter them, if you are an accredited investor, is to enter them via private placements, because almost all of them will need to finance in the next 12 months simply to stay alive until the price responds. My own belief is that that speculation is worth entertaining because uranium is probably the single most volatile sector that I've ever been exposed to in my life. And when it moves up, it really, meaning the sector, the stocks in the sector move up, they really, really move up. Let's do a little history just for fun, Charlotte. Uh, Going back to the last uranium bull market, we went into that market with only 5 uranium juniors worldwide. Only 5 companies had survived a 20-year bear market. The poorest performing of those 5 in the ensuing 5 years went up 22-fold, not 22%, 22-fold. That's why people hang out in the uranium space. We've gone, well, full cycle. At the top of the cycle, when everybody wanted to own uranium, we went from having 5 uranium stocks in the sector to having 500 in the sector. Now we've declined from 500 to probably 20. In other words, nobody wants to be in the sector when it has to go up, and everybody wanted to be in the sector when it almost had to go down. That's why I like the sector. But it's not for the faint of heart. It's not for people who can't take periodic 20 to 25% declines. It's not for people who have trauma holding stock over a long weekend. It's people that have a 2 or 3 year time frame and aren't looking for a 20 or 25% gain, but rather people who are looking for a 10-fold or 15-fold gain and understand the time involved in that and the risks involved in that.
Are there any other sectors like that that have that hate toward them right now that we should be considering or keeping an eye on for the future?
Oil and gas. It's moved up by it. I mean, the oil stocks index has sort of moved up 30% from their bottom. But people all of a sudden seem to believe that the era of oil is over. And they believe that incorrectly. This is pretty easy to document when people think about it. If the people listening to this video uh, would humor me and decide for themselves whether in 5 years, when they moved from the kitchen to the garage or wherever they have their car, and they turn the key to the right, will the car start or won't the car start in 5 years? If they believe that the car will start, with the exception of those 7 of your listeners who own Teslas, if they believe that the car will start, they believe in higher oil prices. You see, the global industry average worldwide for the total cost of production of oil is between $50 and $60 a barrel. If you make the stuff for 60 and you sell it for 40, and you do it 90 million times a year, the industry as a whole loses almost $2 billion a day. Very, very boring. That constrains sustaining capital investment, and it constrains new project investment. And as you pump an oil well longer, the oil well has less productive life. If the industry can't earn its cost of capital over years, it can't produce stuff and the cars don't start. Irrespective of the preferences of some in the US Congress and perhaps your prime minister, irrespective of Greta, the truth is that peak oil demand probably occurs in 2035, and our productive capacity at 40 US dollars a barrel will go much, much lower way before then, leading to shortages. So I would say that the sector that I personally favor after precious metals is easily oil and gas.
It's very interesting because, that electric car green narrative is something that certainly we see on our site with the interest in all the battery metals. For you, is that something you see happening just at a much slower rate than people would hope, or is it not a transition that you would see fully occurring? Are we always going to have some of that oil and gas
We will
needed?
We will always have oil and gas. The truth is that we'll need all forms of energy, Charlotte: uranium, solar, wind. And if you expand the narrative around electric vehicles to electrification, I'm extremely bullish. 1.2 billion people on Earth don't have electricity yet, and they want it. Uh, Distributed storage, which is a fancy way of saying batteries, as an industry, not just for cars, but for all purposes, is an industry literally in its infancy. And it will grow at very rapid rates of speed, but it will grow from such a low base that its ability in the total market for energy worldwide to impact oil demand is silly. What we need to be more concerned about in terms of oil demand is simply the economic strength of the world. Are we going to have an economic slowdown, a real economic slowdown, or are we not? The truth is, we will need all forms of energy. Think about what happens in frontier and emerging markets among poor people. The progression of wealth, and by the way, the poorest of the poor are mercifully progressing rapidly. Transportation goes from barefoot to shoes, to a bicycle, to a 50cc motorcycle, to a Toyota Hilux. The rapid transit in Malawi, I don't think so. Teslas in Malawi, I don't think so either. There's room for all forms of energy, and you can be hugely bullish about the future for things like rare earths and cobalt, and simultaneously be bullish on oil.
Okay. Now, just to follow up on the oil and gas, is that something where you can look at the big stocks and be okay, or should you be considering the full gamut of what's out there?
My experience, Charlotte, has been that if the market that you're looking for may take place 2 years from now, you are best off buying the biggest and the best companies in the space for two reasons. Well, three reasons, really. They exhibit lower risk, maybe lower returns over the course of a bull market, but lower risks up front. The second is that the biggest move first. In other words, they lead the bull market. So the first stocks that move in an oil bull market will be the biggest and the best. The most important reason, though, I've come to learn in my declining years, is the time value of money. If you're 2 years early and you're receiving 3, 4, 5, 6% dividends, you get paid rent on your money while you're waiting for the blessed event to occur. And that turns out to be a substantial advantage. I mean, money is good for the nerves too, but the fact that you get paid rent on your money obviates the time value of money argument against owning the oil stocks.
Okay, that makes a lot of sense. Now, just as we're wrapping up, a couple of questions to sum up the year and look forward to the next year. When you look back at 2020 for gold in the mining sector, how would you sum up this year that we've had?
Spectacular. I mean, truly spectacular. Nothing has really gone wrong, with the exception of the fact that animal spirits, if that's the right phrase, in the summer got too crazy and too much money was raised by too many worthless companies. But you really can't hold it against the industry, the fact that they were willing to accept money from suckers. You have to blame the suckers, not the industry. But in truth, if you look at the real part of the gold industry, the great big guys, the biggest of the biggest and the best, the junior producers, the mid-level producers, on balance, everybody did a good job, and they did a good job with COVID too. By the way, putting people together in fairly narrow, confined spaces. Uh, as an industry, the industry's response to COVID was great. So I would say this year has been a banner year, as good a year as I can remember in terms of corporate performance. And of course, the share prices did well until the end too, setting up, I think, a very nice year in 2021 and 2022.
Right. And as we head into next year, best advice for investors and or speculators.
Well, I'll try and make their life better. Remember that a market is less important than the stocks that you own. A market is a facility for buying and selling assets. It's not a source of information. Further to that, Charlotte, I would like to offer your listeners the opportunity for me personally to rank their mining stock portfolios. Each lesson is individual. Any of your listeners who go to a website, sprottusa.com/rankings, uh, input your natural resource stocks only. Please, no cannabis stocks. Please, no banks. Please, nothing I don't understand. I will personally rank your portfolio 1 to 10, 1 being best, 10 being worst, and I will comment on individual issues where I think my comments might have some value. Further, for those of your listeners who put the word chart somewhere in the request, I will include a 50-year chart of the Barron's Gold Mining Index, which is the best visual aid to understanding the gold equities markets I know, and a 100-year commodity chart, which will go a long way to answering questions about things like copper, nickel, oil and gas, and uranium. Once again, sprottusa.com/rankings. You know, Charlotte, I've learned that in terms of some of what I really like to do, which is educating people, the best form of education I can give them is one that's centered around their own portfolio because the advice becomes more personal and less esoteric, and people take it to heart more easily. So I would say, in terms of education and paradigm for next year, let's do it on a stock by stock basis.
Okay, well, that sounds like a perfect place to end. And thank you very much for that offer. We'll make sure to put the link in the description of the video below. Thank you so much for being here today.
Charlotte, thank you so much. I look forward for the point in time when we can do these live again. I'm right across the border, but sadly I can't see you face to face until vaccines or whatever intercede. But it was very nice to see your face, albeit on Zoom.
You as well, and I do hope that time comes soon. Once again, I'm Charlotte McLeod with the Investing News Network, and this is Rick Rule of Sprott.